Valuation, a good valuation is a bridge between story and numbers, as was the model. Since 2020, the financial markets have been more than volatile. An economic recession is ahead of us. Grupo Mexico and all of us here must be prepared for any outcome. Good afternoon, we are the Escuela Bancaria y Comercial from Campus Mérida, and today we will walk you through our financial strategy and why we issued a buy recommendation in this stock. We have a target price of $4.15, which represents an upside of 11.80% on the closing date of October 27.
Grupo Mexico started its business construction in 1941 through Mexico Compañía Constructora. It is the largest copper company in Mexico and Peru and the fifth lowest cash cost copper producer in the world. The segments are mining with 81.8%, infrastructure with 1.41%, and transportation with 16.7%. The revenue is mainly diversified between Mexico, US, Europe, Asia, and Latin. Grupo Mexico is positioned as the fourth largest competitor with 11% by public market share behind Jiangxi, Freeport-McMoRan, and Arubis.
Regarding transportation, mining, and infrastructure divisions, Grupo Mexico's ESG score is above the industry peers, demonstrating a firm step in the consideration of the natural work and the relationship with their people. As you can see, the total ESG score of Grupo Mexico represents 61 points. They had a total growth of 7% for the last 4 years. For Grupo Mexico, people are fundamental. They are the driving force of the company. That is why, in the social segment, they increased 19 points against the industry average. There are some areas of opportunities that I want to mention, specifically in governance and in corporate governance. The first one is the gender gap. In the board of directors, only 6% are a women working force. There is a 1.03 women to men's base salary ratio, a 2.2% increase in the energy consumption, and a 35% growth in the historical waste generation, representing more than 200,000 tons of hazardous and non-hazardous waste.
Grupo Mexico has efficient financial strategies, which compose of revenue growth, cost performance, profitability, and financial health. So let's talk about the revenue. The company presents a good future outlook, taking into account cyclical patterns, but with a stable and organic growth revenue, having a compound annual growth rate of 3.6%. Also, there are key factors that must accompany this growth, which are expand production capacity, commodities prices, infrastructure and transport expansion, and continued investment in new technology for the smart mines. Grupo Mexico has the lowest cost production in industry worldwide. In 2021, the company had a solid 62% in gross margin, in which the cash cost per pound for the same year was at $0.84, and in the last 9 months continues his superior position than peers with a $1.13. However, there is a cost catalyst where the company gets a great cost performance, with a 40% of the costs are in Mexican pesos, and 92% from the sales are in dollars. So we can see from the graphs that Grupo Mexico outperforming peers in gross margin since 2017 until today. Grupo Mexico has a high profitability per business segment, where the costs have been stable and decreased in infrastructure and transport division. But the mining division is the first line of the business segment where the with the lowest cost and operating expenses. Also, the company leads position with peers in financial performance with solid margins and the principal returns.
Regarding financial health, in the last 5 years, Grupo Mexico has maintained a low leverage, which we consider as a wise decision due to the natural cyclicity and volatility of its business. We can see from the graphs that the leverage ratios are considerably low. For example, the total debt to EBITDA has been always below 2 since 2017. However, it has maintained a low leverage, which is also lower than the industry average. Likewise, he highlighted how this ratio decreased from 2019 to 2021 by 1 time. This is a sign of good leverage management, and we expect the pattern to continue.
For valuation, we took into consideration 3 different models to make the analysis: multiples, DDM, and the DCF model. Regarding multiples, we took the most relevant between the enterprise value and the price, being this was enterprise to sales, to EBITDA, to free cash flow, price to earnings, to sales ratio, and to book value. For the industry, we took the median of the peers that we exposed recently in the overview section. And with this, we conclude that the stock of Grupo Mexico is undervalued, since the fair value is of $5 against the real value of 3.71. For the DDM, since Grupo Mexico has a dividend policy, we took the trailing 12 months with a dividend of $0.25 and the ROE of 20.29%, and the product with the ratio. We have 3 different scenarios. A bullish scenario regarding the policies in the payout of 56.70%. For the expected scenario, we have a payout of 59.96 with a fair value of $4.50. And for the bearish scenario, we have a payout of 70.77%, giving us a fair value of $3.22.
Lastly, we have the DCF model, which is the one that we obtain a target price from. For the cash flows, we took into consideration the free cash flow to firm, also known as on-level free cash flows. And the way that we estimated them was through an analysis of historical ratios, and then applied them to the sales forecast that we saw in the financial analysis section. Now, because we're using on-level free cash flows, then our ideal discount factor is the WACC, because it takes into account the company's leverage. Therefore, we computed the cost of equity through the capital model by taking the weighted average of the risk-free rate, ERP and CDS, by sales per region. The cost of debt, again, was a weighted average of the current cost for the company's debt. And then for the perpetual rate, we use this approach by taking the weighted average of the expected GDP growth for 2034 of all the economies where Grupo Mexico has operations in. Now, because this is a model that is based on estimations, and therefore they might not be 100% accurate, that we considered that it was necessary to find a distribution for the fair value. The mean of this distribution is our target price, which is of $4.15. Having a value at risk with respect to the target price of 13.2%, but only 2.89% with respect to the current price. That gives us expected upside of 11.80%. Moreover, we have 3 different scenarios based on the confidence intervals for the sales forecast with a confidence level of 95%. We can also see the different returns in each case, which supports the conclusions from the previous models. We also made a sensitivity analysis for the model in order to measure how sensible it was against WACC and growth rate. We have a delta WACC of 1% because we consider this to be a reasonable amount of change in WACC, either up or down. And a delta growth rate of 0.1% because of the same reasons. And because of that, we can see from the sensitivity analysis that the DCF model is more sensitive to changes in WACC than changes in growth rate. We also consider several risks. We can see from this risk matrix that the highest risk is the market risk related to the stock price, but this is due to the rationality of the market in the short term. The other risks either have a low probability or low severity, and therefore might be properly managed. In this table, you can see some of the techniques and methodologies that we use in order to measure this risk. For example, for the DCF and for the stock price, we use multi-color simulations based on sales distributions and return distributions respectively. So based on all the factors that we have presented here, we can see that there's a bullish feeling on the stock, and that's what we issue our recommendation. Having a target price of $4.15 with an expected upside of 11.80%, but moreover, having an upside probability of 90% based on the fair value distribution. Thank you.
Thanks for the presentation. I have one question. Why do you have a buy recommendation when the upside you have it's only 11.1%?
Okay. Grupo Mexico's stock is undervalued. That 11.80% is extra yield that a company is given.
Yeah, actually, based on the APT theory and carbon theory, we know that there is a security market line. And if a stock falls in this security market line, then it's providing a return that is related to its risk. Now, if it's over the line or under the line, then it's underrated or overrated respectively. In our case, we have an undervalued stock. That means that it's providing more return than it would be expected from its risk. The expected return is again our cost of equity, but that extra return is the difference between the stock being in the security market line and the stock in its current position. And therefore, that 11.80% is not just the return that it will be providing, but an extra return that it will be providing, and then added to the return that will be expected due to its risk.
Let me follow up with that question, or let me phrase it in another way. The world is about to enter a recession, or is already in a recession in most of the developed world and in many countries anyway. So copper is Dr. Copper, the name is Dr. Copper, right? It's a good barometer of the economy. So why buy a stock that is mostly leveraged to the price of copper when the world is entering a recession? Who knows by what degree that is a fact. And then your yield is 4.7% for this year. That's almost half of what CETES can give you here in Mexico. So one, why invest in Grupo Mexico amid a recession? Two, why invest in a stock that yields half of what CETES with no risk can give you at this point?
Well, first, in a recession, it is regularly a similar factor, something that happens really regularly, that the commodities tend to go up. And we can see here, for example, we have a graph. Here we can see a high correlation between the copper price and the sales for Grupo Mexico. So in the case of a recession, it is very likely that the copper price will go up. And from there, we can have an expected increase in sales. That's why we have three different scenarios for the sales forecast. And these are based on the sales forecast is based on an econometric model, but this is the case of a recession when the copper price must go up. The other question related to the return that it's currently providing. Yes, CETES are providing a high return actually with no risk. Nevertheless, it's not something that's going to last forever. And this investment is in the long term. So we consider that a good year for CETES is not going to provide that same yield for 10 years, for example, which is analyzed that we're providing. So having this, investing in this stock, I guess in the long term, it will be more profitable than investing in CETES.
Thank you. Just to clarify, you said that in a recession, the price of copper will go up.
It tends to go up. It's not necessarily true, but it is very likely when this happens. For example, what happened in 2020, we can see how it went all this way up. Now, again, in the case of the Russia-Ukraine thing, we saw again another rise. It stabilized after all this news, but then again, it could possibly happen again.
Thanks.
I have a question, more philosophical question, but by the way, I did like the quote that you used at the beginning of the presentation, and then during the presentation you said that a couple of times that the company is undervalued, but and a very good and complete analysis, by the way. But in my career, I have seen a lot of people, investors, losing money by buying undervalued or cheap stocks. Because can go much cheaper or much more undervalued. So you look so confident on the 90.71% probability, but in 1 year from now, and I'm not talking about some black swans, but what do you think that can go wrong? And what do you think that could happen against Grupo Mexico and then go against the probabilities that you mentioned?
Well, right now the company investment in new projects for exploration for increment the production capacity. They have some projects in Sonora and other countries, but in specific, we estimate a growth revenue, principal because the company is interested in other areas that the company we will or we can explode, and so why is the reason why the revenue can be increased?
Yeah, also related to the market risk, we pointed that it's the highest one actually, because for example, we can see here, for example, there's a simulation that we did by using a multi-color simulation, and it's with 1 year scope, right? So these are paths that the stock might follow in the future. And yes, actually, in the short term, less than a year, there are a lot of scenarios when the stock goes down. Nevertheless, we want to point out that this is a risk that is related to the rationality of the market in the short term. Again, in the long run, more than 5 years, stocks tend to go to the fair value, to what it really must be on the price. And in the short term, yes, a lot of things can happen. We don't really know. We can see, for example, there are 43.35 scenarios where the stock actually loses value.
Good afternoon. Do you believe that the problem that have the company, the infrastructure division, with the Train Maya contract, could affect the future of this division? Because I saw you are expecting a growth next year, for example.
Regarding the Train Maya situations, since it has become a news recently about Grupo Mexico, we can't say that it's going to be affected directly, since nothing was actually nothing related to the Train Maya was affected in the revenues regarding the infrastructure. So we're not expecting to Grupo Mexico to be affected directly for this.
Yeah, actually, for example, the sales forecast was done through an econometric model that took into account the historical sales. And in those historical sales, the thing with the Train Maya was not already presented there. So the financial statements and the income statement from the past, there is no impact of the Train Maya. And that's why it's not that it's going to have a big impact. Of course, there were high expectations about that, and that's what it could go, for example, to the bull scenario. But in our expected scenario, I think it is not going to affect in a negative way.
Another question, could you explain how do you got a target price when you use 3 different valuation models?
Yeah, actually the DCF.
What the process? What do you do?
Actually, the DCF model is the one that we obtain a target price from. The other 2 were supported to our investment thesis. For example, in the case of the DTM, we saw 3 different scenarios, and they are related with this DCF model. For example, in the DTM, we saw that the versus scenario is the one where there is a high payout. A high payout implies a low reinvestment rate, and a low reinvestment rate implies that there is not much money coming into the company to keep growing, and that impacts directly the revenue and from them the cash flow generating. So in the end, this DCF model is the one that we use to get our target price, and the other 2 were supportive. Thank you so much.
Big pleasure.